Interpretation of financial statement, quick ratio. We began a discussion on liquidity ratios in the last video where we talked about current ratios, compare the current assets, the whole of it, to the whole of the current liabilities. Again, we mentioned that liquidity has to do with the rate at which current asset can be converted into cash to settle the current liabilities. In this episode, we are going to talk about quick ratio. This is also known as the asset test or liquidity ratio. Here, it evaluates the more liquid asset of the business in settling its short-term obligations. So in the current ratio, we talked about the whole current asset being able to settle the whole current liabilities. But here, we're looking at the more liquid ones. Okay, so it shows the extent to which the current assets, as we mentioned, excluding inventory and prepayment, can cover current liabilities. Inventory is determined as less liquid and prepayment compared to the other assets. When we talk about liquidity, we are talking about how a business's asset can be easily converted into cash without losing its value. When you pay cash, it's already in cash, so there's nothing difficult about it. When you pay receivables, the asset or the job has already been done, so there's a right to receive payment. So that can be converted with little difficulty or with ease. We can even factor it, sell the debt off and collect money. When you come to short-term investment, we can just walk to the investment house or the bank, terminate the portfolio with little penalty or none to absorb. But when you come to inventory, you cannot just sell it off because nobody is under any obligation to buy your goods. So if you are able to convert it into cash within the shortest possible time, there is a high likelihood that you're going to reduce the value or you're going to incur much losses. With prepayment as well, the expenses has already been committed to and paid in advance. You have entered yourself into an agreement that you want to incur these expenses in the future and you have paid for it. For example, you have paid electricity for March when you are in February. So you cannot just convert that one into cash. The rest of it is what we call the liquid assets. Then this is a better indicator for investors in the return of their monies, whether the goods that are sold on credit to their business or job done on credit, or the monies that are invested into it, looking for interest or dividends. With the current ratio, the inventory can cause a challenge for the monies to be paid. The formula for quick ratio is current assets less the inventory less the prepayment. Then you divide by the current liabilities. So with the current assets that are considered in the numerator, we have receivables, we have marketable securities such as government bonds, such as treasury bills, such as short-term investments. We have cash as well. Now, in as much as we are doing away with inventory and prepayment, the receivables should not include figures that have some doubt of being recovered. Again, the liabilities, as we already know, the payables or the creditors, bank overdraft, short-term loans, accruals. Analyzing the quick ratio, you are supposed to get above 1.1, meaning you have more liquid assets to settle your liabilities. Anything of 1.1 and below is risky and unhealthy. It means that you don't have enough liquid assets to settle your short-term liabilities, and there's a tendency that your suppliers will call off their credit facilities to you, or investors will be pushed away. Okay, again, we also have to investigate because there can be other credit availability that is not being shown in the financial statement, and it's advisable for the businesses to disclose such lines of credit which can be used to settle debt. Now, if you notice, most of the ratios, it is mainly compared to prior years or players in the industry. With quick ratio, we normally compare it to current ratio in addition to comparing it to prior years or players in the same industry. But the most important is the comparison to current ratio. When you do so, and there is a vast difference between the two, it means that most of the business's current asset is captured in the inventory. On the other hand, when there is a slight difference or it is equal, it means that most of the business's current asset is not in inventory, and it is a good thing for a business to have. Let's test our understanding. Again, this is an extract of the statement of financial position for a business as at 2019. So we have the assets listed here, non-current assets, inventory, receivables, and cash. We didn't bring a comparative year because we just want to compare it to the current ratio. We come to the equity side. We have the share capital and reserves, non-current liabilities, then current liabilities. We will concern ourselves with receivables and cash. Then we pick the current liabilities. For the current asset, we'll just pick the 3 elements in the asset column, compare it with the current liabilities. So for solution, we restate the formula again. So for a quick ratio, you had 0.78 to 1, which was arrived at by dividing the 12,100 for the receivables and cash by the 15,600, which is the current liabilities. So here with a quick ratio, it means that the business does not have enough liquid assets to cover its liabilities. With the current ratio, we had 1.32 to 1. Here, the business has enough assets to settle its liabilities. Okay, so we had this by dividing the entire current assets by the current liabilities of 15,600. Now, there's a difference here. The difference is somehow big. And when we analyze this, it means that most of the business's current assets are in inventory. So it can be interpreted to mean the business is facing distress.